Welcome, and thanks for taking the time to watch this webisode on understanding the capital raising process. It's vitally important for anyone about to embark on the process of raising capital that they've got a good understanding of what the process will entail and what's required along the way. If they don't, then they'll be unprepared and quickly find themselves out of their depth. In the same way as every business is different, no two processes are ever the same. Nevertheless, there are, broadly speaking, 4 stages to a capital raising process: planning, marketing, due diligence, and completion. Okay, so starting with planning. At the outset of the process, it's important that you're clear about what you want to achieve. Ask yourself a series of questions. What do I want? How much capital do I need? And what do I actually need it for? Do I need all of it up front, or can it be staged? Remembering that the option of a staged investment is often preferred by investors. What's my risk appetite? Remember that most investors will want to use an element of debt funding as well as equity. Debt can be good from a returns perspective, but it adds risk to the business's balance sheet. So you need to understand what level of debt you are comfortable with. What am I prepared to give away? What level of equity do I want to retain? Is it important that I maintain control, or will I be happy with a minority stake? Okay, so the next step is to prepare what's called an information memorandum, or an IM for short. The IM is the marketing document that you will share with potential investors. It needs to capture the imagination of the investor and usually in no more than 30 pages explain why investing in your business represents a great opportunity. Beware, however, do not oversell the business and keep the document balanced. Investors, like most of us, do not like being sold to. Another key aspect of the planning phase is to identify the investors you want to approach. It's important to realise that an investor is not just a source of capital. They're going to be a long-term partner for you and the business. Therefore, you need to think about the type of investor you want on board. Do you want someone who's going to be active in the business, or would you rather they're a passive investor? Do you want an investor who's local to your business, or would you be happy with someone that's based overseas? Do you want someone with relevant experience of investing in the tourism industry, or are you comfortable with a generalist investor? If you've got an advisor, they should be able to help you identify suitable investors. If not, just make sure you do your research and ensure those you intend to approach are credible and have got a decent track record. Once you've finished your IM and you know which investors you want to approach, the next phase is the marketing phase, where you start to engage with investors. The initial approach to investors can be either by way of a phone call, an email, or a meeting. It's normal for this to only provide a very high level and anonymous overview of the opportunity. Quite often this is done in the form of a 1 or 2 page summary document called a flyer or a teaser. If the investor is interested in progressing, you typically sign them up to a confidentiality agreement before distributing the IM. The important thing to stress here is that from the moment you engage with investors, you need to control the process. That means telling them what timetable you're working towards and what's required at each step. If you're approaching a number of potential investors and you allow them to dictate how and when they respond, you'll quickly lose control of the process. But if an investor likes what they see in the IM, the next step is typically the management presentation or a pitch. This is your chance to shine in front of an investor and to really sell the opportunity to them, although again, without overselling it. In many ways, however, there shouldn't be too much new ground to cover in the pitch. The investor already will have had an opportunity to review the IM. The pitch should really be a confirmatory presentation and an opportunity for the investor to ask questions. It's also your opportunity to ask questions of the investor, so make sure you think about what you want to get out of that meeting as well. Assuming the pitch goes well and the investor wants to progress, the next step will typically be for them to submit an indicative, non-binding offer. Now, before you get too carried away with the financial aspects of the offer, there are a number of other factors that should be considered before you select your preferred investors. Does the investor have funds in place that they can easily draw down upon, and what's the relevant approvals process? What is their proposed timetable to complete a transaction? What level of debt are they assuming as part of their offer? What due diligence requirements do they have? and what level of control do they want to be able to exercise over the business. Once you've selected your preferred investors, it's time for the due diligence process to start. This would typically cover financial and legal due diligence, but it really depends on the investor and what they determine are the key risk areas of the business. Due diligence can last anywhere from a couple of weeks to a few months, and it can be an extremely overwhelming and distracting process unless the business owner is well prepared. Now, assuming he is well prepared, the due diligence process is largely a confirmatory one and will hopefully result in a business owner receiving final offers. Once final offers have been received and you've negotiated the best possible terms with your preferred investor, you're on the home straight. It's time to document the terms of your deal in legally binding contracts. Now, there will typically be a number of agreements required to document the various aspects of the deal. Some of these are unique to capital raising transactions, and therefore it's critical that you have legal advice from an experienced lawyer. All up, a well-managed and executed process can take 6 months, with each stage taking 1 to 2 months. However, it's not uncommon for them to take considerably longer. The key, like so many things, is to be prepared and go into it with your eyes open. This has been Webisode 3 of 5 in the series. We hope it's been helpful for you, and don't forget to download the additional information based on this topic located on the Webisode's landing page. For further information, please refer to the contact details on your screen.